To talk about all of this, we're joined by Karl Schamotta, Chief Market Strategist at Corpay. Thank you, Karl, for coming in.
Thank you very much for having me.
Our investors were justified in being worried about higher rates for a longer period of time.
Yes, indeed. So basically every indicator that we look at is pointing to a cyclical recovery in the U.S. and in global economies. So, essentially what this means is that we're going to hear more of the same from central bankers. We're going to hear more of the, there's no rush to cut rates sort of rhetoric that we've been hearing. And that is forcing markets to pull back on expectations for the back half of the year. Right now, we have 3 cuts priced into the curve for the U.S. in the back half of the year, but odds are going down by the day, essentially, on a move, in June or July. And so ultimately, that means that borrowing costs are a bit higher. That means that some of those assumptions that sort of underpinned markets rallies through the latter part of last year are being pulled back, and everyone's looking at sort of a new day in markets overall.
Why has it taken April for markets to realize this? What happened in the first quarter when markets took
That's the real question, right? So it is kind of crazy. I think markets got way over their skis last year in assuming that we'd see such a radical pace of easing, especially given that there were no, material storm clouds on the horizon at that time. And it has taken sort of a gradual sort of climb down through the last couple of months. And it's basically been the data, right? The fact that consumers keep spending, that balance sheets remain in relatively healthy state, that businesses are investing in the U.S., that all of these sort of underlying momentum factors are pushing in the right direction, as well as the fact that, although other economies are underperforming the U.S., they're not falling off a cliff, right? So that global manufacturing sector, which was sort of evidenced in the PMIs that we've been seeing in the last couple of weeks, those are really pointing toward a recovery elsewhere as well. And so typically we see the global manufacturing cycle leading what happens in the economy, and that is helping to boost global growth expectations right now. Among
the most influential economic releases, of course, are the non-farm payrolls reports out of the U.S. We've got one queued up for Friday. It's due on Friday morning, as are the Canadian job numbers. The consensus call is 214,000 jobs added to the Canadian economy, the U.S. economy during the month of March. What happens if a stronger job number lands?
Right. A stronger jobs number is like another positive surprise that wouldn't be surprising. I would kind of put it that way, right? We keep seeing these numbers beat expectations to the top side. And so, I think that markets are somewhat braced for that possibility, which means that the dollar would pop a bit, yields would pop a bit, but I don't think, we'd see a huge outsized reaction. All that said, if we do see, something really surprising continue, if we see a couple more months of this, then that June, July rate cut is going to go out the window, and market participants are going to move toward expecting something to happen in September instead.
The change in employment in Canada, meanwhile, expected to be 25,000 jobs added to the economy during the month of March. The Canadian dollar, you're an expert in the currency. Where do you see the Canadian dollar going over the next 6 or 12 months?
I try to be an expert in the currency, but let's be real, there's no such thing. So the reality is, I think the Canadian economy is in a position right now where we could see a bit of a melt up. We know that we are seeing improving sentiment. We know that consumers are spending a little bit more. We know that housing markets, as you mentioned earlier, are beginning to recover a bit. That really sets the stage for a slightly more cautious approach from the Bank of Canada, and a convergence in expected growth differentials between the Canadian economy and the U.S. And so all of that, to me, means that the Canadian dollar could actually outperform a bit in the coming months. We could see a bit of a gain, maybe 2 or 3 cents, but that those long-term structural factors, mainly debt, anchor the Canadian dollar further down later in the year, and we begin to see sort of, that Wile E. Coyote moment in which the Canadian economy, where market participants kind of look down and realize that there's more weakness in the Canadian economy than was priced into currency markets.
The price of oil has rallied significantly. Is that as much of a factor as it used to be in the Canadian dollar?
Absolutely not. Correlations between the West Texas Intermediate price and the Canadian dollar have dropped dramatically over the last couple of years. We're far more correlated on a positive side with the S&P 500. So in other words, a great earnings release in the U.S. can actually pop the Canadian dollar up. Conversely, an increase in the U.S. 10-year yield will tend to hamper the Canadian dollar or damage the Canadian dollar because that borrowing cost is assumed to go up in Canada. Canada. And so we are seeing that lift in oil prices. I do think it is going to become a factor, especially in terms of what our overall inflation expectations are. We are seeing sort of a secular widening in calendar spreads in the oil market, which suggests that the demand and supply imbalance is getting a little out of line. That could mean that when central bankers look at the direction of inflation, that they're going to have another reason to avoid moving too early and starting to cut rates.